So let's get started with understanding some stuff about price action. And price action is what happens on our charts. To really understand price action means that you need to study what has happened in the past, then observe what is happening in the present, and then predict where the markets will go. Okay, past, future, present. Didn't I see something in Star Trek about that? But to understand how an asset should behave, we have to know all three. Price action is among the most popular trading concepts. A trader who knows how to use price action the right way can improve his performance and his way of looking at charts significantly. However, there's still a lot of misunderstanding and half-truths circulating that confuse traders and set them up for failure. In this webinar, we're going to explore some different price action secrets. So what is price action? It's a favorite amongst short and medium-term traders. Price action trading brings together an interesting mix of information and different views. These include historic price patterns, technical indicators, and the investor or the trader's ability to read the markets. Many investors see the stock market as an information exchange. Now, that's an interesting way to look at things, where all views and strategies meet and try to arrive at a fair price in the end. This explains why price action trading strategies do not involve fundamental analysis of an individual market or commodity. We're also not concerned where price meets all strategies. We're looking for an opportunity to take advantage of some disproportionate or out of proportion in our charts. As many of the decisions associated with price action trading are subjective. What one investor may see as a breakout, another may see as a potential price reversal. Compare and contrast this with pure technical analysis, where you effectively ignore the experience of traders in favor of cold, hard trends. Human nature dictates that futures, commodities price, forex prices can be extremely volatile. Now, when we stop to think that the market is made up of millions and millions of human beings making human decisions. Now, granted, we all say there's black boxes out there. We say there's robotic trading. We say there's all these scanners and robots and AIs doing all this. The fact is, the market is made up of people like you and me. Now, we retail traders only make a small percentage of this. Hedge fund managers, investment managers, financial companies, banks, they all are the bigger proportion of it. But just think, here's John Smith. He's the hedge fund manager, and he's the Euro trader for one big bank. He trades millions and millions and millions of dollars a day. His trade's worth billions of dollars. Now, John Smith had been doing his analysis last night on the Euro-US dollar. And he had this edgy feeling inside, it should jump up today for some reason. Now, in the morning when he gets up early in the morning, he comes to work in the middle, almost the middle of the night. He does a quick assessment. He decides as soon as he gets in the euro and gets the computer on, he's probably going to, in the office, he's going to make a big trade in the euro. Now, on his way out the door, for some reason, he has a fight with his wife. A little bickering thing. Puts him in a little bit of an edgy, bad mood. Not a horrible mood. But then he's coming to work, and it's halfway in the middle of the night. It's 5 in the morning, and he's got a long drive, and there's an accident at the entrance to the highway. Well, now he's stuck. Okay, he's waiting for the police to let the cars go by. He's getting annoyed. Okay. Now he's delayed another 15 minutes. He gets on the highway. Now he's in a really wicked mood. Traffic's getting heavy. 15 minutes really affected him. He gets to the office, and he's about a half hour late. Okay, I know this is a long story. But John gets in the office. He's a half hour late. He's in a bad mood. So that trade he was thinking about making, that 10 million euros he was going to buy this morning. He doesn't get around to making it because his mood is sour. These guys, this is what they're doing. And, they're the experts. They're, the bank, sure, he'll make a whole bunch of other trades today, or maybe he'll make that same trade in 2 hours now. They're looking at profit. But what happened was, because John was in a bad mood, had a little indiscretion with the wife, had a little traffic accident on the way to work, his little trade in the markets could have shifted the euro one way or another. Not enough to make a difference, but he was a human being affecting the markets. Not that he can control. The markets are way too big for any one person, one trade. But when you stop to think of all of it's made up of human beings around the globe. Now, overbought situations are often created because of fear and greed, while panic selling can take over in the event of disappointing news. These are the types of scenarios where price action investment strategies can prove extremely lucrative. The key to reading price action charts is to take in short-term fluctuations. It's also critical to notice emerging trends and focus on patterns which repeat time and time again. You will hear talk of swing patterns, support and resistance, wave analysis, trend analysis, moving average, to name a few. Candlesticks and bar are also very important. Pattern recognition. Okay. Let's pop up some live charts here for us a second here. Okay. So what's critically important is that we can see what is happening in price. Now, both of these charts, this is the euro US dollar, and this is on a 1 hour chart. This is the euro US dollar on a 30-minute chart. Okay. Now, when we go to my 1 hour, you can see I have my levels of support and resistance. These are the blue and the red. Now, I haven't been on line in a while, but look at last time. Just a few days ago when I was using this chart for teaching, okay, we saw a nice up move. We saw a indecision candle at our resistance level, and then we saw it move above. Well, that tells us that the euro could be moving upward. It's going to continue its uptrend because it's been steadily trending up. Okay. Here it broke back down, but it didn't come as low as our resistance level, so it didn't make a new low. And now look at that. It continued its continuous up pattern. That would have offered us a beautiful trading opportunity based on nothing but reading our charts. Now, here we're looking at Ripple, and here we're looking at triangles. Triangles is another price action strategy. Now, when we got the breakout here of our triangle, we saw price moving into this beautifully well-developed triangle. And here we got our breakout. Okay. We had to wait all through here to get a confirmation candle, but then we got a confirmation candle at this point, and that's telling us to trade going up. We would have made some nice profit on Ripple. Okay. This is using charts to trade, looking at historical movements of price, current movements of price. Here we're looking again at another asset, and you can see all of my circles here. You can see our levels of support and resistance here. You can see how price is reacting. Now here, let me put my marker on here. Okay. We had expected price to trade to here. If it hit this resistance level and broke through, we had expected to go to here. Well, we got a bounce off of its support level here. It bounced down, but then look what happened. It reversed and followed the exact trajectory of what we had predicted. Again, this is using charts and historical pricing without using indicators, fundamental analysis, or any other technical analysis except interpreting price. Now here we're looking at Bitcoin. We all know what Bitcoin has done. And we saw Bitcoin hit the 20,000 level the other day. And of course, when it hit 19.8 and couldn't make the 20,000, it got sold off immediately because all those buyers have been buying, riding it up, said it's not going to go any higher than 20,000. It hasn't. And they sold off. We had a lot of sells. They tried to remake it. And look at this. We got a beautiful triangle. And then we got the breakout. We got the breakout confirmation, and we could have taken advantage of this dip. And we're probably going to see the Bitcoin somewhere down to 16,000. Now, I happen to be really lucky. Okay, I don't trade Bitcoin, okay, at all. But I happen to have some because I accumulated them teaching classes over the last couple of years in Bitcoin. I had to have money in wallets to show students and all this other stuff. So I let it sit there. Now, when Bitcoin here hit 19.6, I sold off my Bitcoin. I didn't take it out of the account. I just sold it into US dollars. And then when it fell back down to, I bought it back at 14. But we were able to buy in this range and bought it back. And now I'm still sitting on it. But it came from looking at price action. Now, would this have been a difficult chart to make a decision? Look at it. Every level of support and resistance was broken. And then we got our beautiful triangle formation. Again, this is price action. This is nothing but looking at your charts. Now, when a chart is about to crash through a support level, it's unlikely to do it in one fell swoop. You may see an index or commodity contract price initially bouncing off a support level as investors look to benefit from short selling sell-offs. As short-term traders sell into the bounce, buying interest begins to wane and sellers again take control. Eventually, the price will crash through the support level, often promoting an array of short selling. So we have different charts and different ways to read price action. There are many different types of chart patterns we associate with price action trading. Some of these are fairly obvious, while others are open to interpretation. Once you understand what they really mean, you will start to notice many of them on your charts. Now, we have the bullish head and shoulders. Now, a head and shoulders is a well-known trading pattern, except I don't trade it because I find it too complicated to see in my price charts. But when price is forming that right shoulder of the bullish head and the inverted or the head and shoulders or the inverted head and shoulders, okay, and that right shoulder has formed and it breaks through the, comes down to the neckline, forms a right shoulder and then bounces off of it. That tells you that there are some really good opportunities. And we can look at trading volume to see if it helps us make our decision. But we can see neckline, shoulder, head, neckline, shoulder. At this point, right here, we have a very, very strong bullish indicator. Okay. Then we have double tops and double bottoms. Okay. To be honest with you, in our type of trading, short-term trading, it appears often. And I don't put much validity in double tops or double bottoms. Triple tops and triple bottoms start to give me something worth looking at. Here, we can go look here. And see here what we have are lots of triple tops and triple bottoms. Okay. Price is stuck in, touches the top, comes back down to form a bottom, comes to the top, comes back to form a bottom, comes to the top. Okay. And then we get our action. Okay. So we have a lot of choices, but a double bottom, double top is not so strong. Triple top, triple bottom are a lot more informative and a lot more reliable to risk your funds. Now, there is an indication of support around the level of the two low points with a gradual recovery back towards the resistance level. What typically happens is that initial sell-off goes overboard and buyers return right after. This pushes the prices through the resistance levels and back towards previous levels. So what do you have? Double bottom. But for me, you need that triple bottom. You need that third wave. Here we go. Triple bottom. Then you have something much more reliable. Now, this is another type of bottom. Okay. It's hard to see, but it's fairly easy to interpret. It's called a rounding bottom. Price keeps making bottoms, but they don't get lower and lower. But as you can see, they start to round about. They start to curve. And then we have things like the bullish island and the bullish rectangle. Bullish rectangles like a double bottom, double top. A bullish island reversal is basically a rounded bottom, except it has a price gap. And then we get the bullish wedge. Well, bullish wedge to me is no different than any other triangle. It's very reliable when you get the breakout. And we have ascending triangles also. So the key to any successful price action trading strategy is to remove peripheral noise such as fundamental data and look at price patterns, trends, and other forms of technical analysis. When combined with good old-fashioned experience and a feel for the markets, this can create a very successful investment strategy. Don't forget, even if you opened a position based on any of the following price action strategies, you can also use technical data to set your stop losses. And remember, always manage your risk. Never take a position without calculating your risk and putting a stop loss. So one of the key aspects of price action trading when using support and resistance levels is the fact that once a support level is breached, it can then turn into a resistance level and vice versa. It is sometimes worth noting that while traders tend to focus on volatile periods of contraction of contracting commodities prices or forex prices, most of the time they tend to trade sideways markets, all within a relatively modest range. Now, when we looked at our chart here, what we actually had is sideways consolidation, but it offered us many trading opportunities. So remember, we have three types of trends we can trade: uptrends, downtrends, and sideways. So always keep that in mind, but always be aware of what trend is being taking place at the moment. And then, of course, we have my favorite, support and resistance. Okay. And then we have things like, I mentioned charts already. We have the ping bar inside bar combo pattern, and it's seen by many as one of the most powerful technical indicators. As you will see from the example that I'm going to show you in a second, and it can be extremely lucrative to recognize in time. The pin bar and inside bar combination shows what is effectively a short-term sell-off before the exchange rate consolidates and then moves significantly higher. If you look towards the start of this chart, you can see that the exchange rate bounced off resistance level while the pin bar and the inside bar combination highlighted the peak. So here you can see it. Okay. Now pin bars they came from the old days when we traded bar charts. Now we see them as candlesticks. Okay. So a pin bar and a sidebar, as you can see here, are candles that are bouncing off the resistance or the support level. And you have pin bar here, and then you have the inside pin bar, which forms inside the previous prices. Many price action traders are extremely vigilant. They're always on the lookout for what is known as an inside bar pattern. Now, if you want to know more details on inside bars and what we call mother bars, we have an entire class on just inside bars and mother bars. You can recognize these by the emergence of the secondary bar within the body of the previous bar. So here's the mother bar, and then the inside bar is a candlestick or a bar chart, if you're looking at a bar chart, that formed within and fits within the body of the previous candle. So the previous candle is then considered the mother bar, and then the inside bar is the candle that would have fit inside. The primary bar is sometimes called the mother bar and will often indicate a period of consolidation and potential turning points from key resistance and support levels. This is the beginning of a changing trend and marks a downtrend movement. To see one mother bar inside a bar occurrence is encouraging. To see two inside bars side by side is even a more reliable indicator. see the examples here on the chart? Now, remember when we looked at this chart, see here's the mother bar, inside bar, and a second inside bar. That tells you that you have a very big opportunity coming your way. Now, it is only when you take the time to understand how bar patterns emerge and what they indicate that you can position your trades. Don't forget also to keep one eye on a stop loss limit. As you'll gather from all the above information, price action trading is based around trends and momentum. The idea is simple. Once a trend changes, then the momentum often grows. It is only when a stronger or opposing trend emerges that the direction changes again. In between these relatively strong trends, there is a period of consolidation, sideways trading, and prices will often bounce off support and resistance levels in between, playing ping pong. In many ways, support and resistance levels are self-fulfilling prophecies. Many traders now use technical analysis and take them into consideration. However, price action trading offers the best of both worlds, with both technical analysis and human input from a trader. Don't take action with a trade until the market itself confirms your opinion. Being a little late in a trade is insurance that your opinion is correct. In other words, don't be an impatient trader. Now, there are numerous disadvantages and advantages using price action trading strategies, and ultimately, it comes down to how disciplined you are as a trader. Some of the disadvantages include relatively low number of trades. Okay. Price action, if you have dedicated price action strategies and you're a dedicated price, like I'm a price action trader, you don't get that many perfect examples, don't that many perfect opportunities. So you have to be disciplined and wait for them to present themselves. Unfortunately, traders using price action trading are often caught out by significant shifts in the market. This often means prices do not return to their preferred trading levels. Many of the strategies we mentioned above can be overcautious by some people. While waiting for a definitive change in trend, there may be times when intraday prices could spike above or below support levels and then recover. Like I teach in my triangles class, and I'm a triangle trader, is don't trade the breakout. I always wait for a confirmation candle and trade on the third candle because I don't want a zillion trades. I want the highest probability trade possible with the lowest risk. So I could trade all week and only get a couple trades in. When looking at chart trends, not all traders will have the same opinion. Some will go long while others will look to go short in the market. These decisions are based on the opinion of the technical analysis opposed to fundamentals. So as we touched, while price action trading is based on technical analysis and reading of the situation, it's not always cut and dry. After hitting a new high on an exchange rate, prices will fall back. While it depends on the support and resistance levels, one trader may expect a double top and then move to higher ground. However, a different trader may see this as the start of a new downtrend. In that scenario, continued profit taking could push the price below the support. So two traders could look at the same price chart and see different opportunities. So one classic indicator that a trend is changing is high trading volume. So if the price is stuck in a range bound bouncing between resistance and support under relatively low volumes, one investor may see this as a trading opportunity, while another investor may see the lack of interest and assume a likely breakthrough the support level at some point prompts a strong momentum. Again, being a price action trader, I use volume to confirm my trade. If I see a breakout of a triangle, when I get that confirmation candle, I better see a spike in volume. Otherwise, I'm not interested in making a trade because most likely it's a false breakout or the price is going to move back into a triangle again. To me, I'm not looking for low volume. I'm looking for increase in volume to confirm my decisions. Now, these simple answers to the question is yes in the right hands. Price action trading does demand discipline and it can be successful. Price action strategies can highlight periods of consolidation and new emergence of new trends and phases of sideways trading. The key is to see what's in front of you as opposed to trying to manipulate the chart data into what you would like to see. The basic difference is that price action incorporates both technical analysis and human input. Effectively, you are monitoring emerging trends and reading these with varying degrees of discipline and experience. While there's a degree of human input with regards to the price action trading, there's also a need to be disciplined even if you marginally miss out on several trades. The idea is blunt. When the turning point occurs, the momentum builds for a new trend, and you will see and you will be there. So make sure you take your time, discipline yourself, set your rules for your price action trading, and you may get few trades, but those trades should be successful. And always, always, always calculate your risk reward ratio, set your target price, and use your stop loss. And if that trade doesn't fit your risk reward ratio, do not make the trade. So thank you very much for joining us. If you want to learn more about price action trading, go to www.alvexo.com and go over to the Education Center, and you will find all you need to know. Thank you very much, and have a successful trading day. Bye now.